Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about investment markets this week and what to look out for in the days ahead. Now, where we are this week is largely where we were this time last week. The FTSE 100 is still around 7,500. The S&P 500 over in America is still hanging around the 3,000 level. In Germany, the DAX is at 12,500, there or thereabouts. The 10-year US Treasury yield is about 2.05%, so just above that 2% level. And if you look at the VIX, the market fear gauge, then that is still just below 13. So if you look at that, everything still seems pretty awesome, bearing in mind that we are already into earnings season. Now, last week I talked about a couple of key results to look out for. One was Netflix, which actually disappointed, and we saw the market sell off quite aggressively the share price of Netflix. It was down at double digits, about 12% just after the results came out, largely because of the poor subscriber growth numbers. We had Microsoft, which was more about quality of earnings. That actually cheered the market, and we saw their share price go up marginally. So where are we on earnings season? At the moment, there's nothing too shocking that's happened. We've still got a long way to go. We've still got to find out the impact of Trump's trade war with China. But at the moment, equity markets are still holding up quite nicely. Now, that is largely because the market is still really only concerned about what the Fed does next week. The US Federal Reserve, will it cut rates by 0.25% or even by 0.5%? We will find out by the time we do this next show of Midweek Markets, and that is a big event. It could move markets either way. If the Fed is very dovish, then we could see markets bounce higher. I'm talking about equity markets in particular. If the Fed is hawkish, then we could see equity markets tumble. But of course, on top of that, we've had some fairly positive news around Trump's trade war. Apparently, some US negotiators are heading towards China next week to continue the trade war talks. We'll see what happens there. So next week is a particularly nervy week for investors because it could be very good or very bad. So we'll have to wait and see on that front. But if you look at the market, like I said, it seems everything's very good, but there are some cracks elsewhere. If you look at the economic numbers, for example, in Germany, their PMI manufacturing numbers came in very low. They disappointed. So it seems that the German economy is still struggling. The US 10-year yield is hitting lower highs. That means that the market has bounced back up. So the yield has got higher, but that high hasn't extended above any previous highs. It's actually then turned around and started heading lower again. That shows a lack of conviction. And that's something that we're seeing across the board. We're seeing far more negative yields in European bonds. And that is a sign that people are A, nervous, but B, worried about economic growth, both in America and in Europe. And of course, we're still seeing the yield curve inverted. We covered that off in a previous episode of this show, so go back and have a look at it. But we're seeing bond yield curves inverted around the world, which again could be a key sign that we may have a recession on the cards in a not too distant future. And to top that all off, the oil price has been falling in the last week or so. We've seen a bit of a bounce, largely around geopolitical concerns, so particularly concerning Iran. Now, a falling oil price can also be a sign of economic concerns, particularly in China. So we're getting this idea that not everything is great economically around the world. We're still in that scenario. So there is a chance that we could see some backlash in equity markets in the next quarter or so if equity investors do suddenly believe that the central banks can't stave off some kind of recession, and therefore we could get some mean reversion of equity markets. It's something to bear in mind. For UK investors, we've got the added complication of our own politics. Now, we've had Boris Johnson. He's just about to be announced as the next Prime Minister of the UK. And if you've been watching the pound versus various different currencies, but particularly the dollar, you will have seen it wobbling and lots of volatility, and it tumbled. It went back down to that $1.24 level as people became concerned, increasingly so, that we may have a no-deal Brexit come October. Now, at the moment, if you look at professional traders, they are trying to hedge out some of the volatility that they could see in the coming months as we approach that October deadline, because if a no-deal Brexit becomes more and more likely and there's a lot of uncertainty, the value of the pound is likely to whipsaw. And we've had some analysts, the most pessimistic of them, thinking that the pound could go down to parity with the dollar. Now that would be good for your overseas holdings. It would be a boost for anything that was large cap UK, like a FTSE 100 tracker, but of course it won't be good for UK inflation, and of course anything that's domestically focused when it comes to investing if our economy suffers. So I'm talking about things like FTSE mid-cap stocks. So to round it up this week, we've got a lot of uncertainty on the cards, but there's still the big event is next week. What will the Fed do when it comes to monetary policy? Will they cut rates? And if so, by how much? Because that is what the market is still really concerned about. So that is it for this week on Midweek Markets. If you want to contact me, you can do in the usual ways. Damien at moneytothemasses.com is the email address, and of course via Twitter at moneytothemasses with the number 2. Until next week.